So Jamie, since we last spoke in November 2025, obviously that was just after the peak of the bull market. What do you think is the main reason that we've had this sort of 9 months pullback in the digital asset market?
Bitcoin follows a liquidity cycle, and these liquidity cycles are typically about 5 years. And if the liquidity cycle started in 2022 in Q4, then my expectation was that in some point in 2026 we would top. So what I was seeing in Q4 was just that. It was the basis for a correction. But look, every market tops for its own reasons, and liquidity is still one of the major drivers of asset cycles. The difference here is that typically all risk markets will top very closely. Bitcoin, because it's the most liquidity sensitive risk asset, will usually top first. And then, and I'm talking within 3 to 4, 5 months is the usual pattern, S&P and NASDAQ would usually top out as well as we top out in the liquidity cycle. Now that hasn't happened. We've actually seen extraordinary strength in other risk assets, while crypto has underperformed significantly and is by any measure in a bear market. And the cycle top was clearly in Q4.
My guest today has spent more than 2 decades in financial markets, starting out as a stockbroker here in Australia before joining Bloomberg in 2014. While at Bloomberg Intelligence, he built the firm's first crypto research product, covering market structure, asset and sector analysis for institutional clients. He also founded Helios Analytics, his own digital asset research and consultancy. And today, he's chief crypto analyst at Real Vision, where his work blends macro, technical, quantitative, and on-chain analysis. Jamie Coutts, welcome to the podcast.
Hi, James. Thanks for inviting me on.
So Jamie, since we last spoke in November 2025, obviously that was just after the peak of the bull market. What do you think is the main reason that we've had this 9 months pullback in the digital asset market? And where do you see things going over the next 6 months?
Yeah, that's the most important question in crypto right now, because I think it caught a lot of people off guard, including me, because, at the time in September, I was raising the red flag that there was actually going to be a major correction in Q4 for the reasons I'll explain. But, to my detriment, I didn't call it the end of cycle correction or the end of cycle and then the ensuing bear market. I actually thought it was going to be somewhat of a mid-cycle, but in my framework, essentially Bitcoin follows a liquidity cycle, and these liquidity cycles are typically about 5 years. And if the liquidity cycle started in 2022 in Q4, then my expectation was that in some point in 2026 we would top. So what I was seeing in Q4, I thought was just that. It was the basis for a correction. But look, every market tops for its own reasons, and liquidity is still one of the major drivers of asset cycles. Although for reasons I'll explain because I imagine that's where you want to go in terms of like the nuances with liquidity. The difference here is that typically all risk markets will top very closely. Bitcoin, because it's the most liquidity sensitive risk asset, will usually top first. And then months, and I'm talking within 3 to 4, 5 months, I think is the usual pattern, S&P and NASDAQ would usually top out as well as we sort of top out in the liquidity cycle. Now that hasn't happened. We've actually seen extraordinary strength in other risk assets, while crypto has underperformed significantly and is by any measure in a bear market. And the cycle top was clearly in Q4. So the reasons for that, it was essentially the confluence of different things. What I was highlighting at the start of September, when no one was really wanting to listen to me and I was getting a lot of flack, was that Bitcoin price action alone on the really important timeframes, which are weekly charts, not daily charts because they're too noisy, we're showing signs of momentum degradation into September, meaning the major peaks in the bull market that we had seen up until at that point, September, were lower highs on momentum indicators. So it's just a technical analysis framework that says nothing more than markets are that the asset or the market that you're looking at is losing momentum velocity. And that typically is a warning. And it's not always the end of cycle signal, but it is at least a really good indicator of a decent correction. And because it happens on the weekly, these are really meaningful. And because I've been in markets for, way too long, going back to the .com bubble and sort of following technical analysis for, 20 of those years, I have seen momentum divergences at all the major turning points, the S&P, the US markets in 2007 into 2020. when I was following Asia, it happened in the Nikkei several times, and it was always a really good signal. Now, what happened after that? Bitcoin actually made a new high in October, but then it coincided with the Binance issue, to put it lightly, which was a massive deleveraging event caused by their Oracle and really lousy infrastructure, to say the least. A major event which, if we had proper regulations and proper frameworks, segregation of exchange duties and responsibilities, I would argue that it may still have happened, but could have been lessened in terms of the severity. So the market structure basically broke. It cleared out all the leverage. One of the things that I was highlighting in September as well was that open interest in altcoins on perps was nearly 2 times that of Bitcoin. It was at an extreme high. So there was so much leverage and speculation on the lower quality assets within the crypto space that also was a red flag. And then we had the confluence of the Binance event combined with quantitative tightening, which had started in 22, which was just about to reach the end of its life because stress was starting to appear in the repo market, and we started to see SOFR rates blow out. So there was stress in the financial system. There wasn't enough bank reserves to keep the system functioning. Then there was the government shutdown. So excuse after excuse after excuse, but those confluence of things, I think, definitely made it, unwound a 30% correction, which was kind of like my base case into this, end of cycle bear market that we're in now. What happened in December? Well, the Federal Reserve pivoted to QE again. They call it RMP. They're buying, bills. They're not buying Treasury bonds, whatever. They're adding liquidity into the system because that is essentially the only game in town now to keep risk assets rising. And of course, we had, to finish it off, a massive rotation into gold, which I'll just park here for a second because there's a nuanced reason for that, but predominantly the AI equity or the AI build out trade, which is legitimately attracting capital. I would argue for the right reasons. Now there's excesses there and there's going to be issues there eventually as well. But that trade is a compelling trade. If you look at Micron and the memory names, yes, they've gone up, 600-700%, but their actual margins, their P's are contracting. So in many sort of places, you can argue it on a whole host of reasons, growth and also valuation. That sucked capital out of crypto. And so all of these things combined. One of the other things that I'll just add is that the on-chain data was deteriorating throughout 2025 as well. So the growth in on-chain activity, which is 100% predictive of prices in the space, was stopped growing at the pace they were in 2023, 2024. So 2025 was starting to see a slowdown there as well. So all those things combined, and we have the bear market they're in today. And I think what's interesting now is how should we be positioned for the next 12 months, which will be, I think, very different.
So you brought up a lot of interesting points there. Just going back to the main first one that you touched on, which was liquidity. Could you just, there's people that follow Real Vision that will know what you're talking about when you say liquidity cycle, but could you just break down exactly what that is and why that has traditionally correlated so highly with risk on assets and Bitcoin?
Yeah. And at Real Vision, there is a host of strategists now. So, there was RAL initially, and now there's 4 macro and crypto strategists. I'm the only one that's doing crypto specifically. So everyone on that team has a different interpretation of the macro and liquidity and has their own frameworks. More or less the same in terms of what the secular debasement story is and why you've got to be exposed to technology and crypto and how that is and how liquidity drives the cycle. But there's definitely differences in terms of what it actually means. And so the research that I do looks at lots of different measures, but the most important thing that I try to track is the momentum of liquidity. And I think people have been caught up on the M2 chart. M2 is just, it's private money. It's not the all-encompassing lens upon which we should view global liquidity. Really, central bank reserves, right, their balance sheet, the collateral in the system, i.e. sovereign bonds, that's used in the repo markets and in sort of the shadow banking markets, whether it's euro, dollar, and in Japanese lending and all these offshore from the US banks that recycle US treasuries as liquidity. And, and that's all dependent really on how much volatility is in the treasury market and the dollar, what it's doing, because the dollar strengthening is tightening global liquidity and all these sorts of things. So that on, the momentum measure that I was looking at essentially topped in Q4 of last year. Now we've had sort of cycles, we've had it sort of oscillating a bit, but essentially that rate of change of global liquidity has continued to go lower and lower this year. So the question really is, where is it going to bottom and what does Bitcoin do around those bottoms? Like, how does it typically react? So that's one aspect. And now if you because we've called it this amorphous term, like global liquidity, and like, what's it actually made up of? I've sort of just described central bank balance sheets and shadow banking in sovereign bonds and whatnot, but also the mechanisms by which global liquidity finds its way into the hands of the people. There's basically now, I think, a very clear distinction between two eras of global liquidity expansion. The first era was the GFC up until 2022, which was central bank balance sheet led quantitative easing. They just went out and bought bonds. And in crises like in COVID, when they, went to extraordinary measures, they were essentially buying corporate bonds. This is out of the Japan playbook that's been around since the 90s. Since then, there's been a shift. And now with Trump and his team, really, because it's really Bessent and another guy called Steve Moran, they're saying no more central bank balance sheet expansion. We want to create liquidity through the traditional channels, which is bank lending. And so when liquidity is channeled through different mechanisms or different sort of front ends, whether it's the central bank or the banks, that money finds its way into the economy or into financial markets in a different way. If you notice, like during the quantitative easing era, we didn't have really high growth. Right? The banks were very constrained. Credit growth was very low during those periods. They had impaired balance sheets. They spent that time restoring it. They had all these rules and regulations, and all the lending went offshore into sort of shadow banking. Now, when that happens, that basically just drives financial assets. So, Bitcoin, tech, everything did really, really well. In this new era, the Treasury is just running massive deficits. They're monetizing the debt through the banks. They're saying, hey, banks, buy all our bills, right? We're going to finance the US government by issuing short-dated paper versus long-dated bonds, because we can't let the long-term yields blow out, because it's now already the second highest budget item, interest expense. So we're going to push to the front end, and by changing the rules, because that's exactly what they did at the start of the year, they're saying to the banks, take on our debt, and when you take on our debt, fractional reserve the hell out of it, lend it out, and when banks lend, they're lending to typically productive users, and the biggest demand now for credit is AI expansion. The hyperscalers are raising bonds. Everyone's trying to raise debt to expand, or to fund the capex. And all this is sort of a long-winded explanation of global liquidity to get to the sort of the bottom line, which is, it's clear that when banks are driving the credit cycle or driving a liquidity cycle, it's going to fund more productive uses, and that funds that drives corporate earnings higher. So we've seen corporate earnings explode, and that's been driving stocks. Now, over here, you got crypto. Crypto essentially has earnings, it has revenue, it has sales in sort of a non-conventional way. But the fact is that block space is not being used, and it's not as productive as it is in the real economy. And when you have that disparity between something that's, running at, what's the right analogy? Like running at 100 kilometers per hour, and this one's running at 25. That also creates a disparity where if you're an investor, you're looking at a thing over here that's red hot versus a thing that's sort of like trunking along.
And in terms of, I guess, the recent news whereby the US has stepped in to prop up the yen markets with, I think the exact number is not confirmed, but it's reported to be $59 billion plus, just to backstop the yen, which is at a 40-year low against the US dollar. Some are commenting on this as like a major shift, and that it's going to be a major liquidity event for markets. Do you think that's the case, or do you think this is just a minor intervention, or are we going to see a lot more of these interventions happening? I'll just add some detail on that, which is Japan's the largest holder of US Treasuries. They've got $1.1 trillion, more than in any other country. And one of the ways that they can support their own currency is they can sell down their assets and buy yen. So selling US debt and buying yen. But of course, as you mentioned, if the long end of the curve, or the 10+ year treasuries, are already at 5.7%, and it's one of the biggest line items in the US deficit, then that would spike treasuries, I suppose, if Japan was to sell off all the US treasuries. So to stop that, is the US now going to get more involved on a consistent basis to backstop the yen? And does that mean we're going to see a lot more US dollar liquidity in the system to do that?
Yeah, so I mean, they're all like really important facts about the situation, right? So it was 59 billion. Is 59 billion a lot? No, but the signal is there that they're going to do more, and they're exercising new facilities or resurrecting new facilities to add more into the future. So I think it's a major signal, even though the nominal amount right now is a drop in the ocean. Now, how does that actually add liquidity? If they can suppress the dollar, then that keeps generally liquidity conditions loose offshore, because there's a lot of outstanding US denominated debt. The majority of debt outstanding is US denominated. So when the dollar rises, that tightens conditions everywhere else because they're repaying that debt in US dollars. So this is a strategy to do two things: is to try to get the US dollar down and obviously the yen up. So ostensibly it's there to protect the Japanese yen, but really what they're doing is trying to protect, as you said, the interest rate costs, or trying to cap the move on the long bond, so that their interest expense as the US government doesn't rise in a disorderly fashion. Now, I don't know whether they're going to be successful at that, to be honest. I dare say this is the tip of the iceberg. Interest expense as a percent of GDP is already now, I think, at record highs. It eclipsed the 1990s high. I think it's gone back to sort of like Second World War levels. And it's extraordinary also for the fact that, this is a liquidity measure that's come in the middle of a raging bull market, right? So, I'm trying to work this through in my head. I was around in the .com era. We had an incident in 1998, LTCM, just after the Asian financial crisis. This time around, we've got situational awareness. They're different in magnitude because situational awareness was their assets were able to be swept up by a hedge fund. In LTCM's case, no hedge fund and no bank could have swallowed the book of that particular hedge fund. So the Fed stepped in, but it's just got this eerie feeling that they're adding liquidity. They're doing extraordinary measures to protect the long bond. They're trying to get the banks to really gobble up all their short-term paper as they run deficits that are at wartime levels. Meanwhile, the markets are absolutely ripping. Just unsure. I think we're in a totally new regime. So the importance of what they've done with the yen, I don't think can be understated. But if you just look at the nominal number, it probably doesn't seem like a lot, but I think it is.
Yeah, it seems like a line in the sand moment. I think Lynn Alden has also commented on this whole theme, the debasement trade, and nothing stops this train. Just we seem to be at a point where whatever the US tries to do, it just seems very clear that there's going to be a lot more debasement in the, you can't say 6 months ahead, but over the next 10, 20 years. And I think that's probably why we're seeing central banks buy significant amounts of gold. Why do you think gold's had this historic run over the last couple of years? Why do you think Bitcoin hasn't?
Yeah, that's a good question. I mean, look, Bitcoin made new all-time highs. It went 6 up from the lows. It only 2x from the previous highs. So, I was disappointed by the cycle, but that's if you're trying to trade the cycles as well, which looks fair enough. People can and should do it if that's their thesis. My view is that this is just a long-term secular trend, and that's always been my base case for why I even got into crypto. Whatever, 10 years on a recreational basis and 5 years on a professional basis. And so the the beta and the elasticity to global liquidity, I think, is in Bitcoin's favor over the long term. But gold has outperformed in the last year. Gold does have these periods of outperformance against Bitcoin too. So it's not the first one. Probably won't be the last one either. But like the importance of like where liquidity is being created right now, and going back to that point of like central bank liquidity versus government or treasury liquidity in this case. The Chinese are the only central bank that are expanding their balance sheets in size. And so when you look at not only what's the mechanism for liquidity, is coming through the central banking system through purchasing of reserves and financial assets, or is it going through bank credit? There's also the other element is it where in the world is it happening? Now, when it happens in China, because of the Michael Howes made this point, like China's restricted crypto ownership. So when they're expanding the balance sheet, which is very deliberate, they're in a massive deflationary trap due to malinvestment over the years in real estate. And the banks are all encumbered with all this bad debt, all this off balance sheet stuff. All the companies have taken on, basically been funded off balance sheet by the banks. So they're just like, they're having to debase to try and get themselves out of it. And the release valve for the locals is buying gold, right? Because they've been basically told not to buy property. And so that is the release valve, and that's been driving the gold price. And it's, the gold price is rising right now as long bonds blow out. So it's also, I think, a telltale sign that there is a shift in trust within the system towards non-sovereign debasement protective assets, because the future looks worse from the point of like, are you going to be debased more in the future than you have in the past? And we've been debased by a ton in the last 15 years.
Yeah. No, it's interesting as well if you look at the various holdings of central banks, not just the Chinese, but across the world. On aggregate, gold is now, I think it's 27%. I just did an analysis recently, 27% of central bank reserve holdings, whereas US Treasuries, I think, have slipped down to 22 or 23%. So,
and not only that, in terms of relative percentages, gold now is the largest, has overtaken treasuries for the first time since the late 90s, when this fiat game went into overdrive, when out of the Cold War, the US and the West had basically said, we've won. And everyone just rushed in to buy US Treasuries as their reserve asset. Gold was dead. Like, why would you want to own gold? US is the only game in town. And of course, as in every regime, when you get too much of a good thing, or you get governments who are just being funded by extraordinarily low rates of interest, they, for lack of a better term, take the piss. And now everyone's realizing they can't sustain, the yields are going to have to rise a ton for people to switch back into it. And that's what I think the switch into gold is telling us.
Just before we move on to tokenization and other topics, do you see like an interest rate at which long-term treasuries cap out? So I was thinking to myself, if you can forward calculate how much additional dollars or liquidity there's going to be in the system because of the deficit that's being run, does that give sort of a fair value of what yield investors will demand? Like, I think it's, if you take all of the US dollars in circulation and then you add on that the interest expense plus deficits, you get to like, I think it's like 7% extra dollars or something per year flooding into the global economy. Could you see treasuries getting up to sort of around that level?
Well, if they're allowed to rise. Yeah. I mean, that's probably some, like this is so outside my ballpark. I mean, I have utter respect for the fixed income people out there because they're always smarter than equity people. And that was my background. They, when they're not being handcuffed and told to buy bonds due to the mandates that they have, but essentially just in the way that they understand risk, fixed income folks are pretty smart. They, I'm sure, have a way to sort of calculate what the fair value of what the 10 years should be. And I would hazard a guess that it's a lot more than where it is right now. I think, if it gets there, it'll be such an attractive regime for people to switch back. Like if you get 8% 8% coupon with, no risk, but obviously, no risk from default essentially. But I think at that point, things would look interesting, but like we're at 4.5. So I'm not looking to switch into bonds for a long time yet. But yeah, I think the fair value is obviously a lot higher. It's all been suppressed.
So in terms of specific crypto positions that you held prior to the correction and now, has any of your theses changed around specific tokens? So I think, some of the most commonly held positions across crypto investors' portfolios were obviously Bitcoin, Ethereum, Solana, hyperliquid, SUI. I know Raul is a big fan of. Have any of the theses changed, or is it just a case of the timing of the market hasn't been there?
So, I mean, in terms of positioning, I personally de-risked in September and October, more so around the Binance event, but I didn't de-risk enough. And so I've written about this extensively. Like I'll own the L's that I get, but I was like one of the only ones I was de-risking at the time. And I got a lot of shit for it because, it was only up from there sort of thing. But in terms of the composition now, I've been running the highest cash position that I have since joining Real Vision. And so we all have our own portfolios on the Real Vision platform so people can track them. So, that's one of the benefits of the platform. Like once you're on, you can see transparently what we're actually doing. Like my portfolio, because I think we're getting reasonably close to a low, I've started to add positions with the idea that I'm just going to use the cash that I have to sort of buy in. I think even though I've been adding, I think there's potential for one more leg lower. But I'm about to write a research report on this at the moment. But some of the research I've been doing is looking at, if you notice here, James, so like the Bitcoin's gone through this very low volatility period. So I've really been trying to understand what typically happens when you have a very extended and extreme in the distribution low volatility period for Bitcoin. And just just because it's top of mind, 75% of the breakouts happen out of this upward moves, and 7 out of the 8 result in extremely strong forward returns on a 30, 60, 90, 180 day basis. There's one that doesn't. Now, this is a very small sample size, so any statisticians out there are going to say that's not statistically significant. It's true. We don't have enough history to do statistically significant things, but it is what it is. On the 4 breakdowns, when we've come through these periods and broken down, 2 of them have resulted in pretty deep declines, but the forward returns on sort of the 60, 90, 100, maybe the 90 and 100 day are actually quite large. So what that tells you is they've happened as the capitulation low. And the other 2 basically just went up. It was only a small downside move. And so you can guess when like the big ones happen, it was March of 2020, COVID. The snapback there was like, severe. It was the biggest. And then the other one was in 2018, where we had one more decent dip lower. There was one in 2022, November. It was like 4 or 5 days, and that was the low. So given all the, the valuation metrics and whatnot, it's starting to feel like this market is building up a low. I'm starting to see a little bit of relative strength from the non-Bitcoin part of the market, right? Which is not enough to really act on with conviction, but interesting because usually out of a cycle low in the market, Bitcoin leads, and it does take time for the rest of the altcoins to recover. I think the use case utility and understanding that blockchains are now part of the financial infrastructure is changing that. And so to get back to your question, the composition has changed. I've started adding in, smart contract platforms and DeFi protocols for the first time. I've never had a DeFi protocol in the portfolio up to just in the last month or 2. And so that is interesting because if you had followed a diversified crypto portfolio through the last cycle, you would have underperformed because Bitcoin there was a couple that outperformed like Tron and whatnot. But Bitcoin really was the leader. And I was 75 to 90% Bitcoin throughout that entire cycle. That's now starting to shift. So that's probably the most significant change in terms of how I'm thinking about the market. And, you're obviously really deep on the tokenization, I guess, expansion or trend. What's tokenization going to run on? It's going to run on blockchain. It's not going to run on Bitcoin. I think the utility and the recognition that these platforms are assets are deemed the same way as a non-sovereign asset is. And because they have a utility, they're going to drive tokenization, financialization, stablecoin payments, global distribution, AI agent infrastructure. they're all going to run on blockchains, I think is starting to emerge as a clear trend. That doesn't mean like, Bitcoin shouldn't be in the portfolio. I just think that the weighting now deserves reconsideration.
I think you're touching on a very interesting point, which is a lot of the early years of crypto, I think, have been defined by speculation and is this new exciting asset class. And Bitcoin, it's scarce, it's got incredible properties, it's fully decentralized. But I think for a lot of the altcoin space, it was just a bit of a speculative mania for many years. We're now seeing that shift whereby stablecoins, obviously, they're the breakout use case for non-Bitcoin positions, where I think more than half of real world assets are tokenized on top of Ethereum. You've got hundreds of millions of transactions individually per day happening on top of Solana. So even though prices for these tokens are 70% plus down, activity on chain has actually gone through the roof. And so we're in this weird scenario at the moment where fundamentals are almost leading price. But I think as an investor, the question that I have, I guess for you, and I think a lot of people would be interested to understand, is it's one thing to have network activity up and to the right and all of these, what you'd call in crypto fundamentals. But for me, the question has always been, does that value find its way back into price? And if so, how? Because it's very clear, I think, with some tokens like Hyperliquid, where, hey, we'll put 99% of the fees for this thing back into buying back the token. They still have inflation in the token as well, which needs to work its way through. But let's just go with the example of Ethereum. It's well below the all-time highs, but it's going to be one of the key beneficiaries as a network for this explosion in tokenization, which is expected to be depending on which investment bank or research report you read, up to $30 trillion market cap sector over the next decade. So
yeah,
do you think blockchains like Ethereum that are hosting this revolution will actually see the price of Ether increase? Or is it just going to be a utility network, but the token isn't really going to be a beneficiary?
Yeah. So look, I think there is something else that's at play here going forward, which we haven't seen before in crypto, in essentially non-Bitcoin crypto blockchains. If you think about like the first, from 2016 to up to 2024 thereabouts, the biggest problem blockchains had, other than utility, other than people using it, was scaling. Like in the 2020 and 2021 cycle, block space on Ethereum was regularly getting filled up, and because of gas, that was spiking the cost to transact on the blockchain. And it was very clear that Ethereum would never be a global distributed layer for global finance unless it learned to scale. Other blockchains realized this very early and launched in that 2019 all the way through to 2023 period. If you think about the generation 3 blockchains like Sui and Aptos, they were all saying that we think demand is going to go through the roof in the future, and you need a blockchain that can process a huge amount of volume and do so at minimal cost with a sufficient level of decentralization to make it a globally distributed and censorship proof network upon which you can do these sorts of activities. And so the industry just set out at that objective very singularly focused. Maybe didn't solve the use case piece very much, but that's sort of just taken care of itself because stablecoins are clearly a thing, as you said. Like, it's the one thing that's product market fit, and a whole industry of DeFi is going to be built around that. So I'm confident of the use of blockchain, of block space going forward. But in that singly focused desire to scale, of which Ethereum achieved success as well through L2s. Now, I would argue that it's not the best way they could have done it because it doesn't accrue as much value to ETH as it should. Nevertheless, they have been successful in bringing in major financial institutions, and it is where most of the TVL is now. So kudos, they've done it. What was lost in that mix, and you touched upon, is supply discipline. The reason why Bitcoin is so desirable is for many different reasons. One of it is its hard cap. It has an inflation rate, but it is a disinflationary protocol. So that is working for you as one of the value drivers. all the other networks, crazy inflation, 7-8%. Yeah, scaling over time, but over a very long time. And then you had the fact that most of these protocols didn't do fair launches. They were driven by VCs, which, I'm not going to be critical of the VCs. It's a problem of the lack of regulatory clarity and all the shit that happened with the SEC going after the industry that pushed everything offshore and pushed the whole ICO into the hands of lawyers and, vested interest groups that were trying to manipulate price and basically just do all this stuff. So you got vesting schedules that are not aligned with the performance of the target. Also, so what I'm trying to say is that massive supply drag, too high inflation, vesting schedules which go on and on and on, that dump and dump and dump, and the fact that most of these were listed at valuations that were never supported by the demand for the asset. Fast forward now, Solana has nearly finished its vesting. NEAR protocol is cutting its inflation rate. Ethereum just announced a staking a staking rewards cut, which I actually disagree with in that instance. But the point is that there is a trend started by Hyperliquid that said, get your ship in order, reduce inflation, work on tokenomic policies like buybacks and burns to accrue value back to the token. And so the thesis now that I'm that I've been publishing on is that we're in a new era where blockchain demand, I think, is going to hockey stick, meets supply discipline where supply is coming down. We've never had that in crypto. And so that is a very strong fundamental reason why I think that some of these assets, not all, some of them will do actually quite well, will outperform other assets going forward.
I agree. I think one of the more fascinating spaces in tokenization right now, obviously stablecoins had its moment in the limelight, and that's likely going to continue and grow, is I don't know if you see some of the posts that get shared from the Kabasi letter guys, but you see the growth in tokenized stocks, and it's like hundreds of % per annum at the current run rate. And so this has been confirmed as well by NASDAQ. They're planning to move on chain. Superhero, I was just reading yesterday, they're a share trading platform in Australia with 500,000 clients. They've just done a deal with Bitstamp and Robinhood, and that's to look at offering crypto as well. But they've also mentioned in the announcement offering tokenized equities. And so I guess the vantage point that we're in right now is, whilst it's a bear market, you can clearly see that the direction of travel is that financial assets are absolutely going to move on chain. It's almost like to think otherwise is almost silly at this point, because it's just 24/7 faster, cheaper. I think outside of tokens, the other interesting play at the minute is, what are the companies, what are the DeFi platforms that you mentioned where there's going to be opportunities, I suppose? Again, coming back to the perspective of an investor, do you see companies like Ondo or Securitize, or I guess even other companies, other layers in the stack that you think will be beneficiaries outside of the tokens themselves?
I mean, one of the clear beneficiaries are borrow-lend protocols. So, the rise of the borrow-lend protocols has been accelerated by stablecoins, which is just a real-world asset. But wait till tokens come on, and wait till you can borrow against your tokens. And then as tokenization expands into more illiquid assets and you get better risk models and risk engines, it opens up a huge opportunity space for global finance, because we all own illiquid stuff. Now, some illiquid stuff is not worth anything to anyone else, but some of it is, like a property or art. And the ability to actually wrap that up on a chain and use that to borrow against, extract liquidity for whatever reason is huge. So that sort of stuff's going to take decades. So it's early. But the first thing that's going to happen is that those tokenized stocks are going to be absorbed into lending pools at Morpho and Aave and the like, and they're going to grow exponentially alongside the growth of equity trading on chain. So yeah, I mean, there's clear winners there. I think options on chain is going to be absolutely massive. And obviously the perps exchanges, they're just taking derivatives contracts on top of real world assets, and people love that product. It's another thing that's achieved product market fit, because CME is copying and doing perps. And I know the other exchanges around the world are going to offer perps as well. So yeah, it's huge. And if you just think about it, like, is that good for the world? Like, ultimately, you are unlocking liquidity. You are reducing friction and fees and intermediaries that clip huge amounts. I mean, the difference of like a 1% commission fee on your stock trading versus 10 basis points can literally mean millions by the time you retire. So all these charges and fees that are in the financial markets from all the middlemen and intermediaries is a huge tax on global productivity and wealth. Then you sort of think about like velocity is one of the clearest metrics to economic growth. That there is more transactions happening, then usually that is correlated very, very highly with economic growth and productivity. Then you've got the biggest productivity explosion of all time is when agents start actually transacting either on our behalf or autonomously. And that's going to start showing up in the data in the next 12 months. You can track it already, but it's really low. But it will appear eventually. All this compute is for what? It's for the agentic commerce future that we're already in, but it's just very nascent. So, it's extremely important from a civilizational perspective. And I know it all gets tied up with speculation and degenerate sort of trading and whatnot, but there is a real problem, right? The financial industry is far too powerful because of its ability to ring fence industries, create regulatory capture, own governments, and therefore extract and provide us with shitty services. And look, BlackRock and all these other guys are all just playing the game, but they're also seeing where it's headed, and they're going to benefit from where the inevitable future lies. And they're going to try to go after maybe lower margins, but higher scale by going into tokenization first. And that's going to leave everyone else who resists that, I think, at a massive disadvantage.
Yeah, I think there's no more clear example of that than in the US, where we've seen the banking lobbyists hold up Clarity for months now, even though there's been largely bipartisan support. I think they can see that there's a threat there, so they want to make sure that they've got their products to market, that the yield or the interest that's payable on these stable coins and assets isn't going to bypass them in any way. So yes, there's no doubt that there's a lot of vested interests in the traditional players, making sure they can capture some of this next trend. Looking ahead over the next 12 months, you mentioned obviously there's the tokenization theme, there's agentic payments. So my two-part question is, if you were going to start a business today in the digital asset space, what would it be? And then the second question is, which 3 tokens would you buy if you could only buy 3?
That first question's a doozy. I guess I can answer from experience because my company, Helios Analytics, is a data analytics company. So I'm launching a crypto analytics portal, leveraging 10 years of experience at Bloomberg as part of the product and sales, but then in Bloomberg Intelligence, starting up the digital research there, and then just years in the market. So I don't know if I can speak to what everyone. I'm probably doing the stupidest thing, right? Where there's lowest margin and where AI is just going to destroy or consumer products like websites and data analytics. But I think there's appetite for. The reason why I think it could still work is because I had to build something for myself because the existing players weren't providing something that I was used to at being at Bloomberg. So I guess I can answer it from my own perspective. That's what I'm doing. I think offering differentiated analysis and insights that's based on data, I think is the way to do something in this space, because one of the things that I think crypto has suffered from is far too much narrative and vibe and not enough underlying data. Like right now, I can talk about the future being really, really rosy, but if I was to give you a synopsis of like, what is the crypto economy? How is the crypto economy performing right now? I'd say it's really lousy. Daily active addresses are down 40-50% from the highs. Stablecoins, which is the product market fit product, is down 5% from its highs. So, I would have thought that would have been up and to the right. So it's not doing well right now. And, providing that data to investors so they know how to size their positions if they're investing in it, and make better judgment calls on the investment into the space, I think is what's needed. So that's what I'm doing on that front. In terms of top 3, well, this is obviously not financial advice, but Bitcoin is the global reserve asset of the future. It is the global collateral, digital collateral of a world that's moving on chain. And so that's just a non-controversial answer. And another non-controversial answer is like, as we sort of, hear the hype around AI and AI supercharging crypto, there's going to be a lot of flashy things that come up or protocols that are doing this and that are going to get our attention. But if you just think about it from, the picks and shovels, like if AI agents are a thing and if tokenization is a thing, then that is going to drive fees. Those fees are going to go to the protocols that provide the best services and the underlying blockchains. That is the infrastructure upon which they will flow. So you can just look where the market is kind of telling you right now are the winners: Ethereum, Solana, and then some of the, size those positions against smaller protocols. So there's three, but I think there's opportunities in the DeFi space, but higher beta, higher risk. So, there's opportunities there as well.
And last question, if, looking back 5 years from now, the thesis hasn't played out, which I don't think will be the case, but what would sort of, I suppose, delay the thesis or, keep us in a rut? What's holding the crypto industry back?
Well, that's a good question. Like, we don't sort of red team ourselves enough. So I think, if I was to look 3 years in the future, I mean, obviously all the data that you can use to justify an investment is expressed in the price. So if prices haven't moved, I think with on-chain, if you've got trading volumes exploding and the prices haven't moved, then that value accrual back to the token isn't being recognized for the market. And that's a signal in and of itself. I don't think that will be the case. I don't think just all this on-chain activity happening is going to give us the sort of outcomes that we've seen in previous cycles. I think it's going to trend more towards the blurring of the line between native crypto assets and equities is probably where we'll sort of meet. And you'll be looking at investment portfolios with a mixture of both and really the lines being blurred. But look, if the assets don't come on chain, I think that's obviously a red flag. So, I've seen these numbers like 30 trillion by 2035 and, 20 trillion, but they've all got different estimates of on-chain assets by 5 years and 10 years from now. I think they're all really overstating it. I think it's going to grow aggressively, but based on just a trajectory with a little bit of aggressive extrapolation, I get to about sort of 3 trillion. So if everyone's expectation is it's going to be 20 or 30 in 5 years' time and we get to 2 or 3, that might disappoint a lot of people. But that's kind of I think, a more pragmatic look at how fast it's going to grow. But yeah, I mean, look, if clarity doesn't get up in 2027, look, I don't know. The SEC is basically putting in rules to actually implement clarity, and they already have. Project tokenization, as you would know, is essentially clarity without the legislation, parts of clarity without the legislation. So I think, provided there's not a major swing in the administration that really goes hard left, and for whatever reason buys crypto, then I think regardless of clarity passing this year, that all roads lead to more tokenization and more on-chain finance. But we'll see it in the numbers, I guess.
Yeah, nice one. Well, thanks so much for your time, Jamie. And so where can people go to see some of the analysis that you're doing currently? Helios, Analytics, and Real Vision?
Just at Real Vision right now, so realvision.com. And so that platform is basically 4 or 5 strategists now and different tiers for that. So you get crypto and macro. So if you're really interested in the AI and macro side of things, then there is that diversification there as well, plus the crypto. Jamie Coutts, and the Helios Analytics portal should be launched in the next month.
Fantastic. Thank you so much. And if you're looking to get into the tokenization space or have a company that you'd like to bring on chain, you can reach out to myself, James, at alphanode.global. We're working with a variety of companies at the moment, from licensing to administration of assets. So feel free to reach out to me. And Jamie, thanks again for your time, mate.
Much appreciated, James. Thanks very much for having me on.